For those of us who have spent the better part of 4 decades navigating the markets, there is a specific aesthetic to security. We were raised on the marble facade, the psychological comfort of a physical institution. To the investor over 40, a brand like JP Morgan, Goldman Sachs, or First American isn't just a company. It's a monument. We were conditioned to believe that the thicker the walls and the more storied the name, the safer the assets within. This is the handshake era legacy, the belief that reputation is a physical shield. But let's be intellectually honest. That marble is now little more than a stage set. In the modern era, the logo on the building has almost zero correlation with the integrity of the ledger. We are currently witnessing a silent, systemic rot in what I call the trusted intermediary model. We've outsourced our discernment to brand names, assuming that their billion-dollar balance sheets equate to impenetrable digital fortresses. As we will see today, that assumption is not just outdated, it is a primary risk factor in your portfolio. This isn't about market volatility. It's about infrastructure fragility. It's time we move past the comfort of the brand and begin a sober audit of the plumbing that actually holds your wealth together. Consider the recent reports surfacing via Bloomberg regarding the FBI's investigation into a significant hack of a major real estate finance tech vendor. For the casual observer, this is just another headline in an era of constant data breaches. But for the analytical investor, this is a post-mortem of a failing system. The breach didn't target the bank in the traditional sense. It targeted the invisible vendors, the tech plumbing that facilitates the flow of real estate transactions. When we look at the Bloomberg analysis, the who and how of the hack are secondary. The why is what should concern you. We have built a financial ecosystem where a single point of failure in a third-party software provider can paralyze billions in transactions. These vendors are the ghost in the machine. You didn't choose them, you may not even know their names. Yet they handle the sensitive data and the title transfers of your most significant illiquid assets. The FBI isn't just investigating a crime. They are documenting the vulnerability of a centralized dependency. We have reached a point where your custodian's reputation is being leveraged by subcontractors you never vetted. This is the first crack in the facade. The realization that your institutional trust is being sublet to the lowest bidder in a software supply chain. To understand how we got here, we must look at the death of the handshake. Historically, trust was localized. If you were a high-net-worth individual in 1985, your risk was human-centric. You knew your banker. You knew the firm's partners. If a mistake was made, it was a localized error with a manageable blast radius. We traded that human-centric, albeit slower, model for the algorithmic dependency model. We prioritized efficiency, speed, and 24/7 access. In doing so, we traded localized risk for systemic vulnerability. We moved from a world where you trusted a person to a world where you trust an API. This transition was sold to us as a technological leap forward, and in many ways it was. But from the perspective of long-term wealth preservation, it was a Faustian bargain. We centralized our data and our trust into a few critical nodes. The handshake has been replaced by an encrypted handshake between servers, but the problem is that while humans are fallible, they don't fail all at once across an entire continent. Algorithms and centralized databases do. When the trusted intermediary moves from a person to a protocol, the nature of risk shifts from linear to exponential. You are no longer protected by the integrity of your local branch manager. You are at the mercy of the systemic resilience of a global network you cannot see and do not control. This leads us to the trusted intermediary trap. It is the most dangerous blind spot in modern wealth management. Most investors over 40 believe that by choosing a too-big-to-fail institution, they have insulated themselves from catastrophe. However, the reality of modern IT infrastructure is that your bank security is only as robust as the weakest link in their vendor stack. Think about the hierarchy of this trap. You vet the bank. The bank, however, does not build all its own software. They outsource their title searches to vendor A. Vendor A outsources their cloud storage to provider B. Provider B employs a third-party cybersecurity firm that uses contractors in a jurisdiction with lax oversight. Your institutional trust is being stretched thin across a dozen different companies, each with their own profit margins and their own incentives to cut corners. When we see a real estate tech hack like the one reported by Bloomberg, we are seeing the trap snap shut. The institution remains standing, their marble columns are uncracked, but the underlying infrastructure, the plumbing, has failed. The security of your million-dollar transaction was, for a moment, dependent on the password hygiene of a junior developer at a third-party software house. This is the core mechanism of failure. We have built a system of extreme technical complexity on top of a foundation of outsourced responsibility. If you are not auditing the technical stack of your custodians, you aren't actually managing risk. You are simply hoping that the trap doesn't catch you in the next cycle. We must accept a hard truth. The era of passive institutional trust is over. The marble facade is a relic of a time when the physical and the digital were separate. Today, they are one and the same, yet our mental models haven't caught up. We continue to rely on brand reputation as a proxy for safety, while the actual threats are bypassing the brand entirely and attacking the infrastructure. In the next part of this analysis, we will move from the why to the how. We will map out the plumbing of finance and provide you with a pragmatic framework, the infrastructure audit. This is how the sophisticated investor transitions from being a passive client to a sovereign participant. We will learn to ask the questions that actually matter, not what was your quarterly return, but what is your redundancy protocol for third-party vendor failure? We aren't here to spread alarm. We are here to build resilience. Because in a world of invisible fragility, the only true security is informed verification. It is time to look behind the logo and inspect the ledger. To understand the current state of financial risk, we must look past the polished mahogany of the executive suite and into the basement, into the digital plumbing that connects every transaction. The recent Bloomberg reports regarding the FBI's investigation into real estate technology vendors, specifically the breach involving First American, are not merely isolated incidents of bad security. They are symptoms of a profound structural fragility. When we speak of the technical dependency map, we are acknowledging that modern finance is no longer a collection of independent institutions, but a tightly coupled stack of third-party software providers. Think of your wealth as water flowing through a series of pipes. You might trust the utility company, your bank, or your brokerage, but the utility company does not manufacture the pipes. They lease them from vendors. In the real estate sector, these vendors handle everything from title insurance and escrow to digital signatures and wire transfers. The Bloomberg analysis highlights a critical vulnerability. The trusted intermediary model has been automated and outsourced. When a single vendor like First American experiences a disruption, it isn't just one company that goes dark. Creates a cascade. Real estate closings across the country grind to a halt. Title searches become impossible. Funds are frozen in digital limbo. This is the plumbing of finance. For the investor over 40, this is a radical departure from the risk models we were raised with. We used to worry about market volatility or interest rate hikes, variables we could see on a chart. Today, the greatest threat to your liquidity is a vulnerability in a software library used by a vendor of a vendor. These are the invisible dependencies. We have traded the friction of the old manual system for a centralized, hyper-efficient digital infrastructure that, while fast, possesses no internal firewalls against systemic failure. If the plumbing fails, the quality of the water becomes irrelevant. The realization that your institution is only as secure as its weakest vendor shouldn't lead to paralysis, but to a new form of due diligence, the infrastructure audit. As sophisticated investors, we have spent decades analyzing P/E ratios and quarterly yields. It is time we apply that same intellectual rigor to the technical stack of our custodians. Moving beyond the brand means accepting that a prestigious name on a skyscraper is no longer a proxy for asset safety. When you sit down with your wealth manager or the head of your family office, the conversation needs to shift. We are no longer asking, what was the return? We are asking, what is the redundancy? You must ask about their technical stack and their third-party risk management protocols. Do they have real-time visibility into the security posture of their vendors? In the event of a total outage at a primary service provider, much like the one reported by Bloomberg, what is their cold start protocol? Do they have secondary, non-correlated infrastructure to ensure your access to liquidity? We must demand transparency regarding data sovereignty and encryption at rest. If your custodian cannot explain in sober and plain English how they isolate your transaction data from the broader, more vulnerable public internet, then they are not managing your risk, they are merely hosting it. This is a shift in the power dynamic. You are moving from a passive consumer of financial services to an active auditor of financial infrastructure. This is not about being a computer scientist. It is about being a prudent steward of legacy. If they cannot provide a map of their dependencies, they don't truly control the assets they claim to protect. In the previous era of investing, the primary objective was return on investment. In the coming decade, the primary objective will be robustness of investment. This is the resilience shift. For the long-term investor, the goal is no longer just the accumulation of capital, but the preservation of access. What is the value of a high-yield portfolio if the infrastructure required to liquidate it is compromised or offline for weeks at a time? Robustness as a concept is often misunderstood. It is not the same as strength. A glass rod is strong, but it is brittle. It shatters under pressure. A steel cable is robust because it is designed to flex and endure. Our current financial institutions are the glass rod, optimized for high-speed performance in fair weather, but prone to catastrophic failure when the digital wind blows. By prioritizing infrastructure transparency over institutional prestige, you are choosing to build your wealth on a foundation of resilience. This shift requires a psychological decoupling from the marble facade. We must learn to value the unsexy components of finance. Multi-signature authorizations, hardware-based security keys, and non-custodial storage options for digital assets. These are the tools of the next decade. They don't offer the same convenience as a one-click mobile app, but they offer something far more valuable to a man who has spent 40 years building his estate: certainty. The next decade of wealth preservation belongs to those who recognize that efficiency is the enemy of security. We are moving toward a world where slow and verified is the ultimate luxury. We find ourselves at a crossroads. The headlines about real estate hacks and FBI investigations are not there to cause panic, but to serve as a necessary awakening. The trusted intermediary model is fading, replaced by a reality where we must take personal responsibility for the technical audit of our lives. This is the sovereign mindset. It is the understanding that while the global financial system is increasingly fragile, your personal strategy can remain anti-fragile. I want to leave you with a sense of reassurance. The vulnerabilities we have discussed are real, but they are also identifiable and manageable for the informed investor. By shifting your focus from the reputation of the institution to the resilience of the infrastructure, you are taking the ultimate step toward true financial sovereignty. You are no longer relying on a brand's promise. You are relying on your own verification. In an age of invisible fragility, the only true security is informed verification. It is time to look behind the logo and inspect the ledger. This is the horizon. We are here to bridge the gap between what is sold and what is real. Stay analytical, stay calm, and above all, stay sovereign. We will see you at the next deep dive.